Good day, everyone, and welcome to today's webinar entitled Beyond Libor Implications for Corporates. I'm your host, PwC Kyriba, and today Kyriba and PwC will be discussing Libor in terms of where we are in that transition process, how this transition affects Treasury, and what you should be considering to prepare, and indeed how Kyriba can assist. So some quick housekeeping rules. We will be recording today's webinar. So if you have any issues, the call drops or any problems with your bandwidth, then rest assured we can share that recording. We'll also be having a Q&A session at the end of the webinar. That said, if you do have any questions as the webinar progresses, then feel free to type your questions in the Q&A box, which you can see on the bottom of the screen, but we'll then address that question at the end of the webinar. So today I'm very pleased to say we have three speakers. First up is Christopher Raftopoulos from PwC. Now Chris is a director within the Treasury and Commodity Trading Group and routinely provides advisory services to help his corporate clients identify and mitigate key financial and operational risks arising from Treasury. He's also responsible for developing PwC's offerings to help corporate clients understand the challenges posed by Libor reform. And joining Chris is Mark Randall. Mark Randall is a financial instruments expert within PwC's specialist accounting consulting services team. And he led PwC's global response to the ISSB's Phase 2 Libor reform proposals and works with valuation, with accounting, and other specialists to develop PwC's point of view on IFRS reporting impacts. Finally, my colleague Adam Bridgewater is joining from our product team. Now Adam is a risk market professional with some 13 years of market experience in derivative valuations at major banks, advisory firms, and indeed, I understand he's actually built his own risk system. So at Kyriba, he is a risk product owner and has been designing the market functionality for the transition from Libor. So without further ado, I am going to pass you over to Chris Raftopoulos. So over to you, Chris. I hope you can hear us okay. Chris, can you hear us? Are you good to go there?
Sorry, I was struggling to find the unmute button. I've now found it.
No problem.
Yeah, there are harder things in life to solve, clearly. So thank you, Kyriba, for inviting us to speak today. At PwC, our purpose encourages us to focus on how we can contribute to solving important problems in society and how business decisions can help build trust. The replacement of Libor is an important problem that the market has to get right, and getting it right will encourage greater trust in those responsible for ensuring this problem is addressed successfully. So what I'd like to do in the next 20 minutes is touch on some of the latest developments impacting corporates and what we think corporates should be doing to get it right. Mark will then give an overview of the latest IFRS accounting developments related to Libor reform before we hand back to Adam from the Kyriba team to take you through their systems perspectives. So on to the next slide, please, Vijay. Before we start, I'd just like to remind you that this is a general update. Practices and conventions are developing continuously. For specific advice based on your facts and circumstances, please contact your usual professional advisors. On to the next slide, please. So let's start with a high-level view. Despite COVID's far-reaching impact, it's not delayed Libor reform. Since the beginning of the year, there have been a number of developments that mean, at a high level, Libor's eventual end date, targeted by the regulators for 31 December 21, remains unchanged. Key milestones have been rephased, and banks, encouraged by their regulators through a carrot and stick approach, are increasing their efforts to reach out to the market to achieve this target and avoid sanction. More specifically, Regulators in the UK and internationally, although sympathetic to COVID's impact on corporates and their priorities, are still more concerned that allowing Libor to continue after the end of 21 would expose the financial markets to greater risk and instability. They are convinced that the new reference rates have shown themselves to be stable and reflective of the interventions they've made to support the markets during the pandemic. That said, certain milestones have been phased later. So for example, although there was an interim milestone for sterling Libor loan products not to be offered beyond September this year, this has been rephased to March next year. Similarly, for sterling Libor derivative products, banks were supposed to stop making these available this year. This milestone is also shifted to March 21 for linear products such as swaps, and later in the year for non-linear products such as options. Regulators are now working on the legislation required to deal with the tough legacy products, which means those that are unable to be converted or amended to include robust fallbacks or alternative reference rates. This will result in legislation to allow the orderly wind down of those arrangements. Effectively, it will legislate for a synthetic Libor equivalent for a period of time. The details of this are still to be determined, but it does come with a health warning, as it may lead to adverse commercial outcomes, and it does not mean that the synthetic Libor equivalent will be available beyond those specific situations. My high-level perspective is that Libor reform is happening, and now is the time to proactively ensure that your organization is ready for this change. There are now less than 400 working days remaining to ensure that the risks and opportunities are understood and addressed. So what are corporates doing about this reform? I know from my own discussions with a large number of UK corporates that they are aware that Libor is going away. And many have taken a view that the market will provide solutions to the issues that its replacement will cause, or it will not have a significant impact, or they have bigger issues to worry about. Many want to see the proposed replacement reference rates come with a forward-looking term structure, so that they don't need to change the way that their systems accrue, value, or forecast interest-related cash flows. For now, I'll refer to this forward-looking term rate structure as term rates, and Adam will explain them in detail later in his presentation. The key point is that Libor has a term rate structure and is forward-looking. You know how much interest you'll pay at the beginning of the interest reset period. For example, today, for a 3-month Libor reset, when payment of interest takes place in 3 months' time. But under the new reference rates, this might only be known in 3 months' time on the morning that the payment of interest is due, depending on the product. An easy way to think about these new reference rates is that they are backward-looking. Other corporates are taking the view that waiting for term rates to be offered to them could result in missed opportunities, that liquidity will move to overnight near risk-free rates, and taking an approach that is not aligned with the market standard and liquidity is likely to be more expensive in the long run and be more susceptible to shocks and surprises. These corporates tend to know what their exposures are across their organizations and across currencies, whether it is worth taking advantage of opportunities to move first, and whether and where their systems and processes need to be enhanced to cater for the specifics of these new reference rates. Some of these corporates are making these changes already with small ticket transactions, or are waiting for the accounting or tax rules to take effect before moving on to the new reference rates. They are also focused on ensuring that they do not create any unnecessary basis risk. I think that for any corporate that is intending to use derivatives to manage its interest rate risk on its borrowings, or indeed assets, that there is a potential for basis risk, or worse, a value transfer to take place if they're not paying attention. Moving on to the next slide, please. So let's take a look at the status of changes at the moment and upcoming developments that are likely to provide more certainty and impetus for action. As you are probably aware, the FCA currently oversees the publication of Libor in 5 currencies. These are set out on the screen now. To make the change away from Libor, working groups in these jurisdictions have established alternatives to Libor. In the UK, this replacement rate is SONIA. Unlike Libor, as I've just mentioned, which is fixed and advanced for a set period, such as 3 months, SONIA is an overnight unsecured rate, measured on each day over the interest period to produce a final interest rate at the end. It's a yearly risk-free rate, excuse me, as it does not include any term bank credit risk or liquidity premium. These differences impact how interest is calculated and when parties to the agreement are able to determine how much interest will be paid on a particular instrument. I think it's fair to say that the transition towards SONIA for sterling LIBOR has real momentum. It's already well established in the swaps markets, and trading volumes for SONIA futures have grown this year. Loans are a key area of focus now, and banks will need to start offering new reference rate products from this month, and will no longer be able to extend LIBOR-linked loans from March 21. The term rate structures that I mentioned earlier that some corporates are waiting for are expected to be derived from derivatives and become available towards the end of the year or early next year, with guidance from the working groups released suggesting it unlikely that the term rate products will be available to most larger corporates, except for certain trade and Islamic finance products, amongst others. So for example, the guidance that I've seen suggests that term rate loans would only be made available to borrowers with revenues that are less than £25 million per annum. Frankly speaking, I'm not sure that waiting for term rates is the right answer. Certainly the regulators have given that health warning. And although the benefit could be that the accrual of interest is the same as currently understood for LIBOR interest accruals, it's likely that most corporates with that type of floating interest rate exposure might like to enter into a derivative to fix that floating interest rate exposure. At the moment, the market is more focused on developing products and liquidity in SONIA on a compounded and arrears basis, rather than for those on a term structure. Therefore, transacting products away from the market standard is likely to cause a basis risk or attract a premium. Turning to the US, where SOFR is being promoted by the working group there as a replacement for dollar LIBOR. SOFR has been in place since early 2018, and so is a relatively recent reference rate. But the local working group there is keen to progress the transition, and the rate is being extensively promoted, despite some requests for additional reference rates that incorporate an element of credit spread within them, such as a Maribor. SOFR differs from SONIA in that it is a secured rate, determined from transactions and repos backed by US Treasuries. Trading volumes are increasing in both derivatives and cash products. Similar to sterling LIBOR, it will not be possible to reference dollar LIBOR in new business loans from 30 June 21. Timelines will vary by product. Term rates are expected to be available in the first half of 21, but this is dependent on there being sufficient liquidity in the SOFR derivative market to derive those term rates. To date, there's no guidance that I've seen on use case restrictions similar to those for SONIA term rates. Moving now to Europe, where there's less pressure in the Eurozone, as Euro LIBOR is not that pervasive. These markets have instead typically relied on Euribor and EONIA. Euribor has been reformed and is expected to continue to be available, whilst EONIA has been replaced by ESTA. Similar to SONIA, ESTA is an overnight unsecured rate. Transition towards ESTA is less advanced than dollar and sterling replacements, with limited volumes and liquidity in derivatives and cash products, and not as much guidance is available on the development of the likely term rates. But given the continued existence of Euribor, I don't see that's a pressing issue. Similar replacement rates for Swiss franc and yen LIBORs have also been identified. These are also slightly different to SOFR and SONIA, and liquidity in these markets remains low, but it's increasing. A term rate structure is expected for TONA, the yen LIBOR replacement, but none is expected for SORON, the Swiss replacement. Finally, I'd like to quickly mention that regulators in several other markets, including Singapore, Canada, Australia, and Hong Kong, are looking to alternative reference rates to enhance the credibility and reliability of their benchmark rates in their markets. So I think there's a lot going on. If there's anything to take away from these developments, it's that if you are wanting to borrow in these currencies, these reforms will impact the interest basis for your loan, bond, and derivative contracts as early as next year, when you may find that you are unable to transact a LIBOR-based loan or derivative. Moving on to the next slide, please. The following slide summarizes the expected developments that I've just mentioned. These will impact future contracts as well as legacy contractual arrangements. One important development that I've not mentioned is the ISDA protocol. The intent of this protocol is that in LIBOR's absence, any reference to a benchmark rate in existing derivative contracts governed by ISDA master agreements will fall back to a standard new definition. These fallback rules are expected to promote fairness and transparency by providing a clear calculation of what the replacement rate would be when LIBOR is no longer available, especially by incorporating a spread to accommodate the differences between IBORs and new reference rates. I think it's worth emphasizing, however, that incorporating a fallback in a contract is not the same as remediating the contract to a new rate. Deciding whether to adopt the protocol for your derivative contracts or renegotiate them instead will require careful consideration, especially if they hedge loans that do not have similar fallback arrangements. The key point here is to ensure that no basis risk or unavoidable value transfer occurs because of differences between fallback arrangements in loan agreements and those in derivatives, particularly when it comes to adopting the ISDA protocol. Beyond the impact on loan and derivative contracts, we see corporates asking many questions about the impact of LIBOR on other contractual arrangements, such as intercompany loan agreements, lease arrangements, and customer and supplier contracts. Here, the accounting, tax, and system impacts are most relevant. Helpfully, the ISB has been working hard to address some of the accounting consequences that could give rise to tax and system considerations. And for that, I'd like to pass over to my colleague, Mark, to take a quick canter through. Mark, over to you.
Thanks a lot, Chris. Yeah. So as Chris just touched on there, looking at specifically international financial reporting standards, the standards setters, the ISB, recently came out with a package of reliefs, the objective of which really was to ensure that as you're kind of navigating through some choppy waters, moving from the old LIBOR world to the new alternative benchmark world, that the accounting rules don't force you into kind of reporting which really doesn't make sense and is not helpful. And in particular, one of the areas of focus was around hedge accounting to make sure that the transition doesn't cause hedges to terminate. And really that's because the existing standards never contemplated anything like LIBOR, and they set a high hurdle in terms of what you need to do and don't really cater for the flexibility and the changes that LIBOR is going to require. So overall, I guess it's a good news story that the accounting standard setters appreciate this. They're trying to help people do the right thing and avoid inappropriate outcomes. But I think, as ever, the devil can be in the detail, and making sure that you've worked through what the accounting tells you to make sure that the actions you're planning to take in the real world don't have unintended financial reporting implications is really the key issue to look out for. So in terms of those, the reliefs that are out there, they're really centered around three areas: cash instruments and leases, hedge accounting, and then disclosures that come with that. Before I talk through each of those three areas briefly, I guess there's some kind of overarching messages. I think the first is that the ISB haven't given people a free pass. So there are criteria that need to be met so that these reliefs are only used for changes that are genuinely related to LIBOR, and effectively prohibit you from smuggling in other changes you might like to make to some of your accounting when they're unrelated to LIBOR. Secondly, that there's inevitably going to be judgments necessary in some of these areas, particularly as we'll talk about on hedge accounting. It's not an easy area at the best of times, and so LIBOR and these new reliefs, they're trying to be helpful, but there's naturally some judgments that need to be made. And then third and lastly, there are some options within the reliefs, and so where there's options, there's decisions you need to take. So look, that's the overview. If I just kind of give you a flavour of what these reliefs are, if I start with kind of the cash instruments and leases. So if you've got an amortized cost liability, a loan or debt funding, Normally, under the pre-existing literature, when you go and modify that contract, you have to recognize a modification gain or loss and work through the calculations of that. There is a relief from having to do that for LIBOR changes, because where the ISB came from is, well, if there's not value transfer here, and it's just an enforced change by regulators, then that is effort that people don't need to go to, and they should be able to just carry on accounting for floating rate instruments as they did in the past. However, there's a but here. Like I said, there's not a free pass. And so to avoid that extra work, you need to meet two criteria. Firstly, that the changes made are a direct consequence of the reform, which I think in practice should be fairly straightforward. But then the more difficult one is they need to be made on an economically equivalent basis. As Chris was saying, kind of there's the risk of value transfer in this area when contracts are amended if you don't keep your eye on the ball. And I think in particular, given what's happened with COVID, when loans go and get modified to change their LIBOR-related clauses, there's a risk that people go in and make other amendments. What the reliefs mean is that you can shelter the LIBOR-related changes under these new reliefs, but those other changes that are unconnected with LIBOR transition, they need to be accounted for separately, just as they would have been done in the past if those changes have been made on their own. So if, for example, the credit spread is going up on your loan liability, kind of you'd expect that to give rise to a modification loss and that hitting your income statement now. So this isn't an opportunity to hide other changes. And so if you think you will make other changes, that's something really to think through. And there can be additional complexities depending upon the form of your legacy fallback clauses. If I then move on to hedge accounting side, similarly, there are reliefs if the changes you're making are direct consequence and they're economically equivalent. And very helpfully, they allow you to go in and make changes to your hedged item as your loan changes, to your hedging instrument as derivative changes, and so forth, which ordinarily you would not be able to do. Normally your hedge documentation is frozen and you've got to terminate and restart again if you want to make changes. So look, that's all good news, but like I touched on before, hedge accounting isn't simple at the best of times. And so, for example, if you're amending your debt and you reflect that in your hedge accounting with something that's often referred to as a hypothetical derivative, there is judgment around how you do that. There is not prescriptive guidance. And I actually think that's helpful that there isn't prescriptive guidance, because the risk always was given that the unforeseen changes that LIBOR could throw out, that guidance, if it was too narrow, kind of tied your hands and wouldn't work when you needed it. But with that little bit of flexibility comes judgment. And I guess another key message here is that whilst the reliefs will prevent you from having to terminate hedges, if there is genuine ineffectiveness, because, for example, there's basis differences between what's the changes on the loan and the changes on the derivative, like Chris mentioned, then you cannot park that and hide that. That has to flow through into the profit and loss. So, like I say, it's not a free pass from everything. And then there can be some complexities if you're transitioning derivatives in ways where you're not simply amending them. And there's also some optionality around whether or not you reset fair value movements in your hedge effectiveness calculation, which could be a helpful thing to do depending on how moves play out. So that's cash instruments and hedge accounting. That's a very high level, but hopefully gives you a flavor. And then lastly, whenever there's a change to accounting standards, there's always a cost in terms of giving some more disclosure. To be fair to the ISB, I think they're relatively easy. There's narrative disclosure around how you're transitioning. The one to watch out for is a quantitative disclosure around the instruments that are yet to transition. The reason for that really is to kind of give users of the accounts a flavor of how much work has an institution got to do. Is it a lot or is it relatively little? And helpfully there, the ISB flex things a bit. So that quantitative disclosure has not got to be kind of your balance sheet accounting measures. For instance, you could use internal management information that's being used to monitor the pace of that transition. So there's some flexibility there. But again, if you're going to use internal MI in your audited accounts, often that's not kind of controlled and validated to the same extent. So you might need to raise the bar on that if that's going to be appearing in your audited financial statements. So look, that's kind of a flavour of the reliefs and what they require. In terms of kind of key actions on the accounting side of thing, I think the first is really to understand, is your institution planning to make any actual modifications to contracts in 2020? If so, I'd really encourage you to early adopt these reliefs. They're mandatory for 2021, but you can bring them forward into 2020. And to be honest, if you're making any changes this year and you don't early adopt, you're going to have to restate next year. So I really don't see why you wouldn't do that. But then if you have a slightly more leisurely timeline because you're going to bring the reliefs in 2021, I still encourage you to really get into the detail, understand how they're going to relate to the changes you're planning to make, understand whether there's any potential gremlins in there that you might need to work through. But I'll hand over to Chris now to talk you through more broadly some of the other actions and things you should be thinking about. Chris.
Thanks, Mark. So in terms of other actions, at the moment, we're urging our clients to take stock and ensure that they've communicated the impact of LIBOR reform to their boards with a clear plan of action. I think it's prudent to show that the risks and opportunities have been considered, and we expect more boards to start asking questions, as will investors, bankers, and other stakeholders, especially as the regulators and working groups increase their outreach efforts. An important part of any plan is gaining visibility of all LIBOR-related exposures, especially those contracts that reference LIBOR, to assess whether these need to be renegotiated or whether the fallback arrangements within them are suitable. Finding such contracts in Treasury should hopefully be relatively straightforward. It tends to be harder to find these exposures outside of Treasury, and there may be both direct and indirect impacts that need to be understood. With this visibility, transition can then be prioritized for those contracts, processes, and systems in most urgent need of attention, to allow time to determine the right strategy and timing for renegotiation or remediation. This should include clarifying the potential legal, tax, and obviously accounting outcomes, especially for hedging derivatives or financial contracts that require terms to be modified, as Mark just explained. It's equally important to ensure that the direct impacts are modeled and communicated. I think that's particularly helpful for boards, but it could also be helpful to some of your investors as they seek to understand whether LIBOR reform will impact their understanding of your business. Finally, it'll also be important to ensure that the organization is operationally ready for the specifics of these new reference rates. And here, I'm particularly referring to the system-related considerations. Next slide, please. To help corporates take stock and update stakeholders, we've made our corporate LIBOR project diagnostic freely available at liborassessment.pwc.co.uk. Please feel free to access directly there. Now, to help you understand what all of this is likely to mean from a systems perspective, I'll hand back to Adam from Kyriba to explain how they are approaching this topic. Adam.
Thank you. Let me share my screen. Good morning. My name is Adam Bridgewater. I am a product owner at Kyriba and here to provide a systems perspective on the market changes arising from the LIBOR transition. If we were only considering moving new trades in the major market around the world from a single 3 or 6 monthly LIBOR rate to a daily compounded risk-free rate, that in itself would require significant adjustments to banking and corporate treasury systems globally. However, when you also factor in the impact of regional differences, such as Switzerland using a different shifting convention to the rest of Europe, the fact that many regions, such as the United States, are still in the process of deciding which methodologies and conventions to implement, that in most regions, detailed information on the technical application of methodologies is not available, and what information that has been released is only in the form of guidance, with new trades in the market currently using a variety convention. And then on top of that, the fact that all systems need to be ready imminently, so both so that they can handle the new risk-free rate trades that are occurring now in the market, but also in preparation for the big 2021 push by banks to migrate all existing trades to the new rate before LIBOR ceases at the end of 2021. Systems will also need to maintain their flexibility so that they can continue to adapt as the market evolves next year. It becomes clear that the demands being asked of systems globally to support the IBOR transition are very significant. The banks have been investing time and money this year converting their commercial lending systems in preparation for the transition, and a reflection of this conversion is also being observed in Treasury systems, as compounding functionality, more likely to be available on swaps, is being migrated to loan and bond lending templates. Kyriba is well positioned to comment early on the market changes, as by design, we use the same mechanisms for swap floating legs for lending schedules, and so have had an early view on the impact repercussions on migrating lending portfolios to compounded rates. In this presentation, we will perform a brief recap of some of the key concepts used in risk-free rates, incorporating some of the system implications for each of these points. To start, 3 months LIBOR is forward-looking. The rate is published and fixed at the start of the period and represents the cost of lending for the next 3 months looking into the future. Risk-free rates are backward-looking. At the end of the interest period, one looks back over the period to see how much interest would have been earned in the overnight market. The key change here to recognize is that LIBOR as a rate was specified under its own conventions. Under risk-free rates, the rate is calculated from the interest period, and so unlike LIBOR, the rate is intrinsically linked to the period it was produced from. To demonstrate this, for a loan linked to 3 months LIBOR with a 2-month interest period stub at the beginning, here at the bottom, of the schedule, historically the rate for this period would be calculated by taking 2/3 of the 3-month LIBOR rate. But under risk-free rates, one would calculate a 2-month rate to be applied for the 2-month period. This is a different definition of a period interest rate, whose calculation has been tied directly to the terms of the trade. Going further, in the market, a shift or lag is normally applied. The terms shift and lag can be defined differently, but are regularly, rightly or wrongly, sometimes used interchangeably in the market. To prevent having to calculate the payment amounts on the day, to prevent calculating the payment amount on the day of payment, a shift allows the amount needing to be paid to be calculated a few days before the payment date. 5 days is often recommended by administrators. However, this can depend on the specific situation, and we have seen different shifts being applied by banks on bonds and loans that are currently in the market. Crucially, going forward, a corporate treasurer will no longer know 1 to 6 months before payment how much is due to be paid, but instead be aware only a matter of days in advance, increasing the reliance on systems and automation for calculation of payment amounts. The backward shift method, also known as look back with observational shift, accurately reflects the rate that would be achieved by investing the notional amount of the transaction in the overnight market 5 days before the start date until 5 days before the end date of the interest period. However, using this method can cause issues, as occasionally the number of days used in calculation of the interest may differ to the number of days in the interest period. Rate administrators resolved this in the reset days prior method, also known as look back without observational shift, by mathematically using the rates from the shifted observation period, but applying those rates to the dates of the interest period. One cannot reproduce this method by investing in the overnight market, but it does mathematically ensure that the number of days used for the rate matches the number of days in the interest period. The lockout method uses rates and dates for the interest period, but keeps the rate constant from the fixing date to the end date of the interest period so that the payment amount can be calculated in advance. The top reset days prior method, sometimes known as lag, has been adopted by administrators in the UK, European Union, and Japan. Switzerland, sometimes known as shift, is using the backward shift method. The US is undecided, but the lockout method is still one of the 3 methods they are considering. All methods have been seen in current initial issuances in the market. In terms of the daily calculation of the rates, there are two possible methods. The arithmetic mean of the rates over the period represents investing the same amount every day at the overnight rate. The geometric or compounding method represents rolling over the amount invested in the overnight market for every day in the interest period, so reinvesting your interest. This is more reflective of the cost of money and has been recommended by all the working groups in the region to use this secondary method. The full formula for which could be seen here using Sonia as example. The rate administrators in the US, Switzerland and UK have also started publishing compounded indices as a way to simplify the calculation of the interest over a period, reducing the reliance on system calculations, the formula for which could see is the second one below here. It is worth mentioning that such an index as this, using such an index as this to calculate the interest rate for an instrument only works if the instrument has the same conventions as the index. For instance, if the shift within the index is 5 days, but the instrument has a 3-day shift, then using the published index will not work. Systems are able to compute this bottom index under different conventions, but often apply the top original non-index form is generally easier within the system. Another interesting topic that is rarely written about but becomes clear in system implementation is handling accrual and forecasting under risk-free rates when partway through the interest period. Unlike Libor, where the accrual calculation is straightforward, under risk-free rates, the system needs to perform a specific risk rate accrual calculation in the period, either by compounding or using an index. Forecasting is even more complex, as one needs to take into account the amount accrued to today and then forecast this using market rates to calculate what the final payment will likely become. Finally, if you lay on top of this complexity mid-period is when you have prepayments of notional amount. This adds additional complexity as well as uncertainty, as there is a very small amount of material on the precise calculation to use and where the rounding should be implemented. It is possible that different banks and regions may start to use different calculations before hopefully converging on a single method. While likely not material in size, this very much matters when agreeing settlement numbers to the dollar, cent or penny. This chart provided by the Bank of England and can be easily replicated using market data shows that when the bank base rate dropped in March, the SONIA rate also decreased, but 3 months Libor did not. A likely major driver of this difference is that 3 months Libor includes 3 months bank credit risk, while in the overnight market, there is only the risk from lending money for 1 day overnight. This suggests that risk-free rates such as SONIA may be more reflective of the cost of money than Libor, and so a better rate to use as a market benchmark. That said, while the overnight rates respond immediately to changes in market sentiment, the compounded average is the cumulative amount of all the rates over the interest period and reacts more slowly to changes in the market, as evidenced by the second chart for the Bank of England. From a systems perspective, the accrual is calculated from the compounded rate, and so the accrued amount will slowly increase or decrease towards the new rate level, effectively catching up to the higher or lower rate. So within our interest rate model, if there is a jump in interest rates in the middle of the period, then this is reflected as a gradual increase or the accrual until the end of the period, which is a useful and interesting system implication. The transition from Libor will also have a significant impact on hedge accounting, as mentioned earlier by PwC. Most accounting models that we'll discuss are relaxing the hedge accounting requirements for the specific instance of Libor transition. There are a number of changes, but for example, where previously we were not allowed to update hedge accounting relationships under ISB, these are now allowed in respect to migrating risk-free rates. In addition, assessment calculation can now only need to occur at the start of the relationship rather than happening on recalculation. Systems need to keep up with these changes in accounting standards and make them available to customers as soon as they become active and ratified. The biggest impact to hedge accounting relationships will likely be on cash flow relationships, as these are to the floating rates or floating rate trades. When migrating the hedge accounting, it is sensible for customers to ensure that the hedging swap and hedging bond or loan are using the same risk-free conventions, e.g. a 5-day shift, as otherwise this could be a source of ineffectiveness. So if you had a swap on 3 days and a loan on 5 days, that could cause issues. In addition, you may wish to consider migrating the hedge accounting for the swap and bond or loan as of the same date or a similar date, as otherwise one could be hedging a risk-free rate loan with a Libor swap or vice versa, causing ineffectiveness. In addition, doing them at similar dates may make updating the documentation easier. In general, we are expecting the valuation of financial instruments to be easier for systems under risk-free rates. One has to worry about fewer curves, i.e. SONIA instead of 1 month, 3 month, and 6 month sterling Libor. In addition, curve building should be simpler in terms of calculations, such as bootstrapping and OS dual curve stripping should no longer be required. Ultimately, for legacy trades, Libor plus margin will equal SONIA plus credit adjustment and the margin. Systems need to allow one to either update the existing margin for the new one, or introduce an additional field for the credit adjustment, which can get complicated where step-up margins exist, etc. Generally, there has been a lack of clarity on the methodology to be used to calculate the credit adjustment. However, the general guidance has been to minimize the transfer of value between counterparties. Systems are likely to be important in this, as they can calculate the value of positions before and after transition to ensure that value is not lost. Advisors will also be able to assist in banking negotiators, etc., to make sure that this doesn't happen. Exotic trades will be harder to transition to risk-free rates, as the underlying market data, e.g. interest rate volatility, cross-currency basis swap spreads, will need to be issued under the new conventions. We are expecting that most of the time, this will occur using the same mechanics as when the market migrated to RAS stripping. Market providers quoted on both conventions for some time until the old conventions became illiquid and were phased out. In most straightforward and well-managed transitions, the transfer of value between counterparties should be minimized, and so valuation should not change significantly. In the event that they do, then there could be knock-on impacts such as to collateral, margin calls, value at risk calculations, and other repercussions for valuations that systems will either need to calculate and ideally predict. The bank rate administrators are all assuming that all portfolios will be novated in 2021. Stopping for a moment and thinking about what that means. It means that the contract for every single floating rate trade in the market that matures after 2021 will need to be rewritten or updated. This will be extremely demanding of both bank and corporate treasury systems, as well as bankers and treasury managers' time. Systems need to be designed so that the rebooking of every trade can be handled quickly and efficiently, effectively leading to systems designing entire workflows for novating away from Libor. When migrating, bank and administrators are not expecting fallback rates to be used in anything other than exceptional circumstances. This is driven by the fact that most active contractual agreements do not define what happens if the Libor benchmark is no longer published. At worst, this will result in floating rate instruments becoming fixed rate instruments linked to the last known rate. At best, the generic fallback rate will be used, which many of the benchmark measures are still in the process of designing. In both instances, these events will most likely result in material changes in the overall valuation of a portfolio, thus leaving one counterparty worse off than they would have been from innovation or migration, and could well result in a rise in legal actions. Finally, a point to bear in mind. These new risk-free rates are mandatory in some regions where the existing index is being discontinued, e.g. USD Libor to software is mandatory, and optional in other regions where the existing index is being maintained, e.g. Euribor and Ester. Note that rate administrators have had one eye on increasing trading and liquidity in derivatives on the new risk-free rates and have already been designing term rates. Term rates are based on the forward market derivatives, such as interest rates on software. These will be forward-looking, like Libor, but require sufficient trading in the derivatives that they are based on for them to be liquid and reliable. Japan has decided to skip designing a backward rate and instead move directly producing a term rate called TORF, or the Tokyo Term Risk-Free Rate, and these have been based on tonar derivatives, or with existing backward rate method. The prototype for this rate has just been published recently. Crystal ball gazing and term rates are likely to be immature and sparsely traded in 2021. This means that the backward rate methodology will be necessary, but that migrating to term rates may be possible in the future. Given that these will be simpler and similar to Libor, there may be demand for them to be used, especially in the corporate market. Although in times of market stress, where forward derivative trading may dry up, this would make the term rates possibly unavailable, but at least considered less reliable. Either this will just be accepted as a function of the market, or presumably a mechanism may be required to reinstate backward calculations as a fallback procedure. From a systems perspective, term rate calculations are expected to be very similar to the current Libor calculations, at least at the moment they are expected to be. So systems will need to keep existing functionality. But a possible market outcome would be for systems in the future to be required to perform backward calculations for specific date periods during times of increased market stress. Only time will tell how the market develops. To conclude, the risk-free rate calculations are more complex than the existing Libor calculations. Hopefully we have provided a good summary of some of the more interesting points. Clearly, there will be great demands being placed on banking and corporate treasury systems to manage the process of migrating all floating rate trades linked to Libor to risk-free rates in 2021 before Libor ends, in addition to the raw demand of simply running complex calculations for so many trades. Methodologies are still rapidly evolving. And in order to satisfactorily serve users, systems will need to respond quickly to the market. Accounting and regulatory changes need to be applied as soon as they are released, and cloud-based systems with frequent, e.g. monthly release cycles will be able to respond more quickly to the market changes. In addition, systems where lending templates already have compounding will be more easily updated, and so we'll be able to bring solutions to market more quickly. Okay, so that's everything for my things. Passing over back to you, Vijay.
Thank you, Adam. That's very comprehensive. So at this stage, we'd like to open the floor up to any questions you have. So whilst you are typing away in the Q&A box along the bottom, I'd like to very quickly point out, or rather reiterate, the Libor assessment which Chris referred to. So on the screen there, you can see a short URL. And what I'm about to do, I'm going to paste it also into the chat box. There we go. So feel free to link and have a look at that. So essentially, what is it? It's a diagnostic tool that helps corporates understand their readiness for Libor reform, and perhaps highlight those areas where action may be required to help move your project forward. So let's have a look at the questions that are coming in. I hope everyone is ready. Let's have a look here. So first question, let's have a look. So do I actually need to do anything, as aren't the regulators putting in steps to help modify cross-legacy contracts? I'll open up to the floor.
I think so. It's Chris. Yeah, you could wait, but I think you're running a huge potential risk depending on the nature of the contract. No, it could be, for example, that you've got a multi-year contract that ends after way after 2021, where doing nothing could see you falling back on the arrangements within the contract, which may be different to where the market eventually ends up, and could result in uncertainty and potential rancor between investors and lenders. So I think that sort of situation could try and rely on regulatory intervention. So the legislation that I referred to earlier in my presentation, but it's really worth taking a look at that and saying, is there a commercial arrangement that could be entered into between investors and lenders that prevents that value transfer that we've all been talking about?
Thank you, Chris. Thank you. This next question, let's have a look. So have risk-free rates been widely adopted in the markets so far? That's a good question.
That is a good question. That's probably, I'll take that one. It's Adam here. There have only been a few issues in the bond markets, and the bond markets have been ahead of the loan markets, and banks are still due to lend sort of loans on risk-free rates from sort of now, actually from September. So I guess not so much more in bonds. Loans are coming. In relation to derivatives, there's actually I've got a link here to a good resource, which is the ISDA Clarus Index. I'll just pull this up, this bookmark I've got here. And it shows the total amount of new issuances on risk-free rates against Libor rates. From memory is about 6.4%, but I will quickly bring it up here. Here we go. And so, yeah, this is the ISDA Clarus Index. So it shows what percentages of derivatives have been issued compared to Libor rates. So we're about 6.4% of derivatives on new risk-free rates. So hopefully that answers that question. That's all from me, Vijay.
Thank you. So let's have a look. Okay, so okay, this is interesting. If I want to cross-check payments in my system, how can I do that? That's probably aimed at you, Adam. System question.
Okay, that's a good question too. So if you want to cross-check your system, one could use the index method that I mentioned earlier, which is take the published index and recalculate the payment that way. But that obviously only works for when the trade and the matches the convention of the published index. If you're wanting to sort of use a sort of simple calculator, I've got another link here, which I'll just pull up. This is a calculator released by NatWest. So if I click on Sonia, you can actually, for simple periods, do calculations using this website. And so that's quite a useful way you could cross-check your system. But of course, this only works in certain situations where it's sort of conventional periods. It wouldn't work for very complex mid-period or split periods.
Okay, thank you. So let's look at the time here. We're only a few minutes over, so I'll perhaps give another 30 seconds for any further questions. So whilst I'm waiting that, I'd just like to point out, if you would like to reach out to either Chris, Mark, or Adam, then the email addresses are there on screen. So yeah, do reach out when you need to. Okay, so no more questions. I think that's probably the last of the questions. Yep. Okay, so all that's left for me to say then is also thank our panelists, Chris and Mark from PwC, and my colleague Adam Bridgewater, and also to our audience today. I know you guys are very busy at the moment, so it's very much appreciated, and have a good day. Thank you very much.